So Powell has done another jumbo rate hike, lifting the interest rates by 75 points. But I want us to understand one thing. He's not done yet. There are more rate hikes coming and he has admitted it multiple times during the Fed press conference. But here's the darker side to Powell's message. He has learned nothing from the Federal Reserve's mistake in 2020 of printing too much money. Now, when the market breaks, we can expect Powell to fire up the printing presses and doom us into a bigger inflation hell down the road. But for now, the sentiment is still very bearish and the market is on the verge of collapsing further. Now, I want us to look through the hopium the markets are selling. The idea that the Fed is going to reverse course anytime soon is a fantasy because they won't. Powell has made it very clear. He said the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. And this tells us that the recent hike of 75 basis points is the sweet spot of demand destruction to bring down inflation, guys. And it confirms this by admitting that the metrics they have been tracking are showing a strong economy. Powell mentioned how we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Remember, we just had Q3 GDP at a positive 2.6%, resetting the recession clock. Plus, we have unemployment at record lows and jobless claims still hovering at historic lows as well. And this is telling the Federal Reserve that people still have jobs, they still have money to spend, and this is keeping inflation high. Now, to burst a lot of people's belief that the worst is over because it isn't. Powell's press conference reveals a lot of truth about what he's going to do. We just need to read between the lines. Now, in the 1980s, Volcker had to jack rates to almost 20% to wrestle down an inflation of 12, 13, or even 14%. So let's just use common sense here. CPI inflation today is 8.2% in September, and the Fed funds rate, even after a recent rate hike, is only at 4% at best. There's a big gap over here. And the main reason why the Fed hasn't doubled rates to 8% or 10% is because they know it will crush the economy instantly. Now, the Fed is playing a game of hope and pray. They are hoping that the supply imbalances in the economy suddenly solves themselves. Powell, he's praying that the war will end tomorrow, OPEC will suddenly pump more oil, and the food shortages magically disappear. Now, I want us to pay attention to this part because it reveals Powell's intentions with interest rates. When asked if the Fed will need to raise rates above inflation, Powell made this statement. We want to get the policy rate to a level where it is, where the real interest rate is positive. We don't want to do that. Now, this is important because it gives us an idea of what the Fed expects and the direction they are taking interest rates. So Powell is looking to create a positive real interest rate environment, which is very bearish for the economy because it creates a bigger incentive to save money instead of spending. And this means there's a good chance that Powell will keep hiking rates to the point the Fed funds exceeds the CPI inflation, or most likely the core inflation rate, which is a measure of how sticky inflation really is. Now, this is a core metric that the Fed watches like a hawk because it takes away price increases from energy and food. So we have the Fed funds now at 4% and sticky inflation at 6.4%. So Powell is likely going to tiptoe his way up while praying inflation comes down on its own. And we could see rates going to 5% or even 6% and only taking a pause once it exceeds either the CPI or core inflation rate. And we need to see the signs and understand the Fed isn't done yet. If we zoom out and see the macro picture, we will understand the supply side of inflation is not improving. In fact, it could be getting worse. And let's focus on the two biggest issues of inflation, which is food and fuel, both of which are highly connected. When it comes to energy, the global price of oil is going to stay high because of geopolitical tensions and the incoming price cap on Russian oil. Now, firstly, OPEC is not going to increase production anytime soon, guys. We have covered this in multiple videos before that Saudi Arabia is now looking out for their best interests. They are looking to maximize revenue in an environment where oil demand could drop thanks to the rate hikes from the Federal Reserve. So if demand drops, OPEC could cut production even more to keep prices high. Now next, the oil price caps are coming. The G7 countries are going to impose a fixed price on Russian oil, despite warnings from Russia. Now, Putin has said time and time again that Russia will not sell their oil under a price cap. And this means the world's largest exporter of oil products is going to restrict their supply to the West directly. So price caps are not going to keep energy inflation down. And when it comes to the food supply, the situation isn't any better. We have the bread baskets of the world, Russia and Ukraine still at war. Now, Ukraine is one of the biggest suppliers of food to the world, and there are over 20 million tons of grain still trapped in the country. Now, this is keeping food prices high. Yes, there's a corridor open now that allows food to be transported around the world, and over the last 3 months, over 9 million tons of food have been transported out of Ukraine through the Black Sea. And this helped to push wheat prices down to $9.30 a barrel, but it's still well above the pre-war levels of $8 and the 2020 levels of under $6. And because the supply side of inflation is either getting worse or not improving, the Federal Reserve has only one tool left to force prices down, and that is demand destruction through rate hikes. Now, I want us to really understand what the Federal Reserve is doing. Here's the simple truth: the Federal Reserve conducts monetary policy like a big pendulum. They swing from fighting inflation by hiking rates to creating inflation by easing rates. That's it. And we need to understand their dual mandate. They are supposed to maintain stable prices while ensuring maximum employment. What do we have today? Highly unstable prices, but employment is still extremely low. The job market looks great, guys. So the Fed has the green light to tighten until something breaks. And the big problem is that their solutions will always just solve the issue short term, but they kick the can down the road. Plus, there's a lag time for monetary policy to work. Just because the Fed hikes or eases doesn't mean the economy will respond immediately. Now, a great example is the inflation hell that we have today. Now, the Fed printed up trillions of dollars in early 2020 to save the economy, taking the balance sheet from $4 trillion to $9 trillion. But it took 1 year for the money to work its way through the system before inflation went from 2% to 5% and beyond. So there's a really good chance that the Federal Reserve will over-tighten because the effects of tightening won't be felt until 2023 at the very least. Remember that tightening started in March, and we started from near zero interest rates, so we haven't come a long way yet. But we need to realize that Powell would rather err on the side of over-tightening to fight inflation, which will likely happen because of the lag effect. And this is where the story gets worse. Now, Powell mentioned in his speech that if the market collapses, he will print money to save the economy. Now, he says, we want to get this exactly right, but if we over-tighten, then we have the ability with our tools, which are powerful, as we have showed at the beginning of the lockdowns, we can support economic activity strongly if that happens. Now, Powell, he's telegraphing the punch, and we need to understand, we need to listen. Eventually, a pivot is going to happen because the Fed is going to tighten and tighten until it chokes the life out of the economy. And if the economy crashes hard enough and unemployment soars, we could see the Federal Reserve print trillions of dollars once again. And by that point, we would have runaway inflation and prices will get out of control, guys. If Powell overcalibrates, if he hikes too much and a collapse happens, he will pivot and head back to quantitative easing. Then we'll repeat this entire BS cycle once again. So we are left with two scenarios. Either Powell will stick the landing somehow and get it just right, or he will overestimate the rate hikes, over-tighten and crash everything. And just in case you were still feeling optimistic, you're still feeling a bit positive, right? A reporter asked Powell if there was still a path towards a soft landing, and he replied by saying, it's narrowed. I would say the path has narrowed over the course of the last year. So we are still on track towards a recession, and it's just a matter of time. So more rate hikes are coming and the US economy is going to tank soon. But the real damage is going to be done abroad. The currency crisis we are seeing today is about to get worse, especially for countries that refuse to tighten. As US rates go higher, the dollar gets stronger because of the interest rate differential widening. Right now, we have a lot of countries still trying to protect their currencies by selling off their US dollar reserves. But unless you combine that with hiking rates, it's going to be a dangerous gamble. You are trying to outlast the Federal Reserve. It's a battle that you won't win. And Japan is a classic example of this. They have been keeping rates extremely low to create more inflation because they believe it will increase economic growth. And we can see the 2-year JGB, the Japanese bonds, at a negative rate, and even the 10-year is below 25 basis points. But money is leaving the Japanese markets and running to US bonds. That is why investors are selling off their yen denominated bonds and buying treasuries because at least they can get over 4% in the 10-year. And as the Federal Reserve keeps hiking, this interest rate differential will only rise. Japan has been trying to prop up the yen with multiple currency interventions, and this time they sold $43 billion to buy back the yen in October, but it isn't working well. The yen is still down 21% year to date, and it has come to the point where Japan now has to inject $490 billion in stimulus to fight inflation, which is mainly from the yen devaluation. And this is going to come in the form of handouts directly to households. This is basically the American stimulus check strategy 101. And we can see Japan has been injecting an insane amount of stimulus for 3 years in a row. And this is going to backfire down the road, guys. You can't print money to solve inflation. You just create a bigger problem. So as the Fed continues to hike rates, we can expect other countries to also raise rates as well. And we are seeing the Bank of England hiking rates by 75 points as well to 3% to keep pace with Powell. The Philippine Central Bank is also matching the Federal Reserve with its own 75-point hike to ensure price stability. The Fed's strategy of global demand destruction is working wonders. So we can expect asset prices to continue to collapse more, especially when we head into winter and the first half of 2023. I'm predicting the Fed to hit at least 5% on the Fed funds rate before Powell considers a pause or slow things down to reassess. But until then, the situation is going to be rather grim. We haven't seen the full extent of Europe's economic destruction yet. We also don't know if the bond market in America will break like what happened in the UK. How much leverage is in the system? There's still a lot of uncertainty that will happen in the next 6 to 12 months because if the markets don't break, and the Fed manages to hike rates above inflation, they could very well keep rates high for a long time to come. But if Powell does over-tighten and key indicators like unemployment starts to break, we could see the Fed pivot happening. So don't be freaked out if the market drops another 5 or 10% in the coming months, especially as we head into Christmas, because I have a really bad feeling about the upcoming earnings reports from companies. And from what I'm seeing, true fear is starting to build in this market. And I'm going to take this chance to gradually start snapping up assets as the market bottoms, especially gold, which will be the number one insurance, at least to me, against the event Powell pivots and starts printing money. So let me know what you think. Is the Fed going to slow down, or will they keep hiking rates until something breaks? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these inflationary times.